Have you ever seen the market have a complete split personality? Well, that's exactly what we're going to decode today. We're looking at one really strange, really contradictory day in the markets, November 18th. It was a day that sent totally opposite signals, and it left a lot of pros just scratching their heads. So let's break down what was really going on. Okay, so let's jump right into this puzzle. On the surface, the market was sending signals that made absolutely no sense together. I mean, imagine you're trying to navigate using a map where half the signs are pointing north and the other half are pointing south. This wasn't just random market noise. This was a really deep structural contradiction playing out in real time. And this slide right here shows that split perfectly. On one side, you have the small caps. These are the smaller, more US-focused companies, and they actually rallied. They went up. But then you look at the other side, the mega caps, the biggest tech giants in the world, and they got, as one trader so elegantly put it, monkey hammered. They were just sold off hard, no questions asked. So how can the market be so optimistic and so pessimistic at the exact same time? What gives? Well, to really understand this, you got to look past the numbers and check the market's emotional temperature. And this quote from the Goldman Sachs trading desk, it just says it all. The real thing in the driver's seat today wasn't logic, it was fear. A high to quite high level of fear was guiding basically every single decision. So where did all this fear come from, right? The answer isn't in one single stock's performance. Nope. For this, we have to zoom way out and look at the big picture economy. And let me tell you, it was flashing some pretty serious red warning lights. And that brings us to the key theme of the day, this idea of macro over micro. When fear gets this high, investors kind of stop caring about how well one specific company is doing. That's the micro stuff. Instead, they start trading based on the big, scary economic headlines. That's the macro picture. And on this day, the macro picture was absolutely everything. And look, we've actually got the data to prove it. Check this out. A whopping 32% of all the trading volume was in ETFs. Now, ETFs are basically these baskets of stocks that let you bet on the entire market or an entire sector all at once. That 42% is a huge jump from the normal 28% average. This is the smoking gun, people. Traders weren't picking individual stocks, they were selling the economy as a whole. So what were these big macro fears? Well, first up, the consumer. The big alarm bell here came from Home Depot. They cut their outlook for the year, which is basically them saying, hey, people are hitting the brakes on big purchases. And when the American consumer, who is really the engine of the entire economy, starts to sputter, Wall Street gets very, very nervous. The second point of stress was coming from the credit markets. The best way to think about this is like the economy's financial plumbing. And that plumbing, well, it was showing some real signs of a clog. Credit was getting tight, which just means it was getting harder and more expensive to borrow money. It's a subtle sign, but it's a critical one. It tells you the system is getting fragile. But the third, and honestly the most powerful warning sign, the one that really moved the needle, was this one. We started getting new data that suggested the job market, which has been the strongest pillar holding up this whole economy for so long, was finally starting to crack. And here's the number that really spooked everyone. 39,000. That's the number of people included in mass layoff announcements in just 1 month. That is one of the highest readings we've ever seen. At this point, it's not just data anymore, is it? It's a real fear that if the jobs start to go, a recession is probably right around the corner. So, with all these fears just swirling around, how did investors actually react? Where did the money end up flowing? Now, in a classic, kind of weird market twist, all of this bad economic news was actually seen as good news for one thing: interest rates. The market immediately started betting that a weaker economy would force the Federal Reserve to start cutting interest rates sooner. And why does that matter? Because lower rates are like rocket fuel for stocks. It makes it cheaper for companies to borrow and invest. This little glimmer of hope is what kept the market from a total nosedive. At the exact same time, though, we saw a classic flight to safety. When fear spikes like this, investors dump risky stuff like tech stocks and they rush into assets that are considered safe havens. And on this day, that meant money was pouring into gold, government bonds, and the US dollar. But even the bond market was telling a complicated story. As you can see here, short-term bonds, like the 2-year, they rallied hard. That's investors betting the Fed is going to cut rates soon. But look at the long-term bonds. They barely moved. That tells you that nobody is really confident about where the economy is going to be years from now. So what you have is short-term hope mixed with a whole lot of long-term uncertainty.
Okay, so with all this fear and uncertainty, you have to be asking, why wasn't it a total market collapse? Well, it's because amidst all that chaos, a few little glimmers of hope started to emerge. These were the positive catalysts that actually stopped the bleeding and put something of a floor under the market. There were really three key positive stories that day. First, Google announced a major AI update, which was a nice reminder of the powerful innovation that's still happening in tech. Second, the crypto market stabilized after a pretty rough patch, which calmed some nerves across the board. And third, Saudi Arabia announced some new AI deals with US firms, which shows that big money is still being invested for the long haul. And all of that brings us to the future. After a day of being yanked back and forth between fear and hope, the entire market is now just holding its breath and focusing all of its attention on a single decisive event. Here's the bottom line. NVIDIA, the undisputed king of this whole AI boom, is reporting its earnings tomorrow. And these results are being seen as the ultimate test. Are they going to validate all the hope we have in AI and technology? Or are they going to confirm all the fears about the wider economy? The answer to that could literally make or break the traditional year-end Santa rally. This quote from Bloomberg just sums it up perfectly. The market is stuck in what they call a negative feedback loop. Fear causes more selling, which in turn causes even more fear. To break out of that cycle, it needs a really powerful catalyst, something so positive it forces all the sellers to just give up and completely changes the story. And so we're left with this one final massive question. The entire market is pinning its hopes and dreams on one single company's report. Is the incredibly powerful story of AI strong enough to conquer the growing fears of an economic recession? That, my friends, is the multi-trillion-dollar question that's about to be answered.